the suppression story is getting more and more difficult for the authorities to continue with gold, because the bullion banks are horribly short of gold contracts on COMEX, and there's no liquidity in London. They may get a little bit of temporary liquidity in London through central bank leasing, and I suspect that's been going on. In fact, we did see that when gold peaked up at over 2,000 in August last year, when GLD announced that some of its gold was being stored in the Bank of England. Now, that can only be because that is leased gold. In other words, the gold in the Bank of England has got two owners. When the dollar fails, and I'm saying when, not if, when the dollar fails, you're going to have the strategic issues of handing enormous power to China and Russia merely by allowing gold to be adopted, if you like, as the sheet anchor behind the new currency arrangements. And that is going to be very difficult, I think, for America, but she's going to have to bite the bullet on it. I'm afraid she's got no alternative.
This is Donegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest. Alasdair Macleod is the head of research at goldmoney.com. He joins us this Monday, February 22nd, 2021. Alasdair, thanks for coming back on.
Thank you for asking me, DK.
We will continue to ask you to come back on because you have been a very insightful source of awareness and understanding for me and for our viewers on what are these remarkable changes that are happening in our fiat currency system, in our banking system, in the metals markets, and so on. What's the relationship between these things and how does it affect the ordinary person? There have been a lot of talk recently about physical shortness, tightness in the physical metals market, the COMEX, the London. We've heard about metals might be on the way from Australia or wherever to save the day for this record delivery month. Yet another record delivery month. Can we start there and talk about something that's physical and real? And that is, what do we know about the availability of physical silver, I guess, particularly to meet the likely or expected demand for physical people, those standing for delivery. And then maybe we can go on from there to talk about other financial topics that are burning on the minds of our viewers.
Absolutely. Well, if I start off with the physical availability, I mean, both gold and silver, there's not a lot of liquidity in the markets. It's been like that in London since certainly I would say since mid-2019. With silver, that's been a more recent development. It's a very different market from gold. I mean, for a start, if you look at the bullion banks, they are short, but they're only short about, I think it's a bit less than 100 million ounces, which is not a lot compared with where they have been in the past. It's almost sort of semi-neutral. But the problem they have is that it's an illiquid market. So, if it runs away, they can't cover. They just cannot cover. And that's obviously what they're frightened of. But the sensitivity of the situation really was exposed when you had this Robin Hood Reddit thing saying, rush out, buy SLV. And at that point, of course, you may remember, I think it was a couple of weeks ago, over the weekend, nobody had any stock to sell. I mean, physical stock to sell. And if they did, they didn't know what level they should cover it and all that, so they weren't going to sell it anyway. And we opened up from $27.50 up to $30 sort of first trading on Monday morning in the Far East. And since then, they've managed to slam it down and keep it down. But now we're coming up to the active month expiry. That's this week. The options expire tomorrow. And I think the last day of trading is Thursday. So we're all going to be very interested to see to what extent people stand for delivery. Now, at the time of this interview, I think there's something like 69,000 contracts outstanding on the March expiry. But I would expect some of those to be sold, roll over, and so on and so forth. But we could still have a very, very significant amount of standing for delivery. And remember, each contract is 5,000 ounces. So this is a fair tonnage of silver. People who are sort of in the silver loop have been exchanging emails, and I've been privy to that. And it's clear there's no silver in London. There's no silver really on COMEX, other than what you see. And remember that on COMEX, the stocks there are in two categories. You've got registered, which is registered to be delivered into the market. Doesn't mean to say it is going to be delivered into the market. It's just registered to be delivered into the market. And you've got eligible, which basically is not eligible to be delivered into the market. I haven't looked at what the most recent bit is, but people have been running around. And the Australian story, which you mentioned, is also very interesting because the Perth Mint and a number of analysts in Australia, who I might call establishment analysts, say, oh, there's no problem. We're ready to ship 40, 50 tons of silver to New York if it's required. But then if you go to the Perth Mint and say, I want to buy some silver, you're shown the door. They haven't got any. Or at least they've got none available for sale. So it could well be that they've got 40 tons ready to put on aircraft to fly off to a COMEX vault. But things are so tight that that's basically all they've got. And they're not letting any other silver out. So that's the Perth Mint. There's none in Switzerland either. I mean, I had a good Swiss friend in the business who called me up a little while ago and said, do you know where to get hold of any silver in London? Because there's none over here. So this is interesting. I mean, this is going to be a very interesting week to see how this situation plays out. I think silver also is a bit of a sort of canary, if you like, in the gold mine, because if the silver contract blows up, and incidentally, I don't think it will, but I'm saying there's a possibility that it will. But if that contract blows up, then the gold situation, I think, then will probably come into play. And this is why they must stop silver blowing up, because if that happens, then you can see that the next thing that's going to be on the radar is going to be gold. And that then becomes very serious, because what you're then talking about is the money at the heart of the international financial system. Because gold is that. I mean, every central bank has got gold in their reserves, and it is the only reserve which has no counterparty risk. So you can see how important gold is. That's what we're watching. So this could be a very interesting week.
That last comment that you made pushed a button for me personally, because my wife and I, as our viewers know, have been contemplating relocating to another state. We were considering some property in Florida. We've been talking to mortgage companies down there. And one of the questions we've asked those mortgage companies is, to what extent do they consider reserves that people might be holding in precious metals such as gold and silver as far as determining their eligibility or their qualification level for mortgages? And some of them say, no, we'd have to, if we can count it at all, it would have to be deeply discounted. And I said, really? Interesting to hear that coming from a bank, because are you aware of Basel III? And then they had never heard of that sort of thing. So just wondering if something just fundamentally different applies at the sovereign level versus at the retail level.
Yeah, no, I mean, that doesn't surprise me at all. I mean, banks at the retail level or local level just haven't got a clue. That's not their function. It's not their job. I mean, they don't know anything. They don't even know anything about risk, really, other than, checking out the form in case Mr. Kaiser wants to borrow some money, what's his income? It's just box tick, box tick, box tick, box tick. The only thing we don't have, so far as I'm aware, are the liar loans that we had back in 2006-7. But, I mean, they've got no idea, actually, about what's going on the international scene.
Let's make sure that we now talk about what's going on with the dollar, because that's one thing, and I guess fiat currencies in general. You've been talking for coming up on 9 months, I guess, about imminent potential for a banking crisis, credit crisis, as well as fiat crisis. And I've been watching your stream of tweets and postings and articles that you put out, and basically pointing out that all the dots are continuing to align in the direction that you've been alerting us to. What are we seeing right now in the breakout of Bitcoin, for example, you mentioned silver being a canary, and E.B. Tucker, when we interviewed him, talked about gold being a truth serum to the financial institution, and John Williams from shadowstats.com, when we interviewed him, said, you will see, gold will tell you ahead of time when inflation is rearing its head. It will give you a signal ahead of time. So with all of that as kind of in our minds, what are you seeing about, for example, cryptocurrency breaking out to new all-time highs that should indicate something to us about the health of the fiat system? And why, if it's telling us the truth, why isn't silver telling us the truth?
Well, let's start with Bitcoin. I think, to me, it's fascinating that we have a whole generation, a millennial generation of sort of reasonably tech-savvy individuals who have learned one thing, and that is that there is a difference in the rate of issue of Bitcoin compared with fiat currencies. And that difference is widening. And therefore, you sell fiat, buy Bitcoin. And it's half the story. The bit they haven't got is the second half of the story, because what they're thinking is, I will see Bitcoin go to $150,000 or whatever figure they pluck out of their heads, because they can see that this is a situation that's going to continue, and as long as it continues, Bitcoin will go up measured in fiat. It's as simple as that. They understand that, but their thinking is still, I will one day make my fortune in Bitcoin and I will sell it for dollars, which I will then spend or invest in something else or whatever it might be. In other words, what they're saying is that the base money is still dollars or euros or pounds or whatever it is. So they've only got half the story. What they don't realize is that the signal that they're actually getting is not so much Bitcoin rising, though of course it is, measured in fiat currencies, but the signal they're getting is that the fiat currencies are going down relative to Bitcoin. And once they understand that, then they'll start thinking seriously about money, what it is, what it should be, and how it is likely to evolve. At the moment, they're all, very heady on profits. I mean, they're just absolutely delighted that they're making so much money, and isn't it wonderful? And they're so clever and all the rest of it. I mean, I accept all that. But they haven't actually thought the thing through, because a lot of people sort of are thinking, well, this is the new form of gold. Forget gold, that's old history, that's old hat. This is going to be the new money of the future. But it can't work as money. It can work as a store of value as long as fiat continues. We'll accept that. We certainly accept that. But when it comes to being the money replacing fiat, what you're looking at, particularly in the case of Bitcoin, is a form of digital currency which is not expanding at all. I mean, let's say in a couple of years' time, it'll basically stop expanding. I mean, and the rate of expansion is so low. So if you have this as money, Bitcoin as money, and it's going to be worth more tomorrow than it is today, measured not in fiat currency, that's gone, but in terms of the goods and services that you buy, then you're going to put off buying goods and services. This is so deflationary that what it will do is it will stop the economy working altogether. So it cannot be money. Think of it another way. Think about the entrepreneur who has this wizard idea that he's going to make something that's going to make an absolute fortune and all the rest of it, and it's needed by the market. But what he needs to do is he needs to borrow money for 5 years to establish the plant, to put in the machinery, to get the trained operatives, get the marketing in place, get the distribution in place, and then finally he can start paying back the loan. Now, he knows what Bitcoin's price is today, give or take quite a lot of change in it. What's it going to be in 5 years' time? I mean, the answer basically is that it is so deflationary that it will mean, even though the entrepreneur has got a very good idea, he will never make money out of it because he cannot afford to repay the capital. So it cannot work. Can you imagine a bond market for Bitcoin? I mean, this is another one that Jim Rickards made the point I've just made this way. Can you imagine a bond market? I mean, how would that operate? I mean, bond markets, if you like, it's the same story, just put another way. And then finally, and this is the very, very important point, if fiat currencies die, and they will, that I have no doubt at all, is the assumption that central banks will die with it? Because if that's the assumption, it is likely to be incorrect. Because the one thing that will survive the death of their currencies is central banks. Now, they will get to the point where they can see their currency dying. But what they will then do is they will use whatever resources they have got to try and stabilize their currencies. Do they have Bitcoin? No. They have gold. So the only way in which their politicians can get paid at the end of the day and continue to get paid, and the army to be paid, and the police to be paid, is to back their currencies with gold. Now, it's obviously not going to be anything like the current rate. I mean, this could be your $100,000 an ounce. Who knows? Who knows at what point suddenly reality intervenes on all these Keynesian dreams, which have been proven to fail. But what we will see is the fiat currency then being used as a means of distribution of the new gold exchange money. So, and by gold exchange money, what I mean is that the only way this can work and stick is that the money must be exchangeable into gold at your option, not the state's option. And to do that, there must be gold coins in circulation. And there must also be silver coins, because obviously, you're going to have two forms of metallic money at least, possibly even three, because the three that always worked were gold, silver, and copper in that order. So, I mean, the only way in which this can end, and there could be all sorts of troubles, political troubles, revolutions, whatever in the whole process, but the only way it can end is a return to metallic money. And the interesting thing is that at that point, when fiat currency is turned into a gold substitute, what is the position of Bitcoin? It's no longer needed. I mean, I cannot see any sense, once you have stabilized the monetary situation, with a practical money which has got the flexibility for the markets, in other words, you and I as users of it, to determine how much of it there should be in circulation and how much we use. Because, I mean, not only do you get mine supply, but also not all gold, above ground gold, is monetary gold. I mean, about 50% of it, I suppose, is in jewelry form, maybe 60%, I don't know. Now, that is a reservoir, if you like, of gold, which can change its use from other uses into monetary use. So it is a flexible thing. But the point is that with that flexible currency, because that is determined by you, me, and all the billions of people around the world, we have a currency where prices are no longer rising because the money is going down. That is the key point. When we reach that point, then having money in Bitcoin is actually the worst thing you can do. So I would say that these cryptocurrencies and all the dreams that people have about them will die along with fiat money. So far, the people who, I mean, Bitcoin tonight, $52,700, I mean, brilliant, lovely. It could well go to 150. I don't know. I really don't know how far it'll go. But, it's not going to be the money of tomorrow. And once that is really proven, the idea that this is a store of value begins to evaporate as well.
Your discussion about Bitcoin's volatility making it difficult to plan a business investment or have a bond market, and then you're talking about it being deflationary because of its fixed issue rate versus fiat unlimited issue rate. Is that second argument not similar to gold? I mean, in that sense, couldn't you make the same criticism of gold, that gold is deflationary and therefore it would...
No, it's a very different situation, because we know that with Bitcoin, there is 22 million is the final amount, or is it 21
million? Yeah.
And that's it, no more. That basically means that if it were to be the future money, then its purchasing power is going to go up and up and up and up and up. And there is absolutely no flexibility in that whatsoever. No flexibility. The question with gold, I mean, if you look at the above ground stocks, there's roughly, say, 200,000 tons, of which at the moment there's about 34,000, which is monetary gold. That would probably expand to a figure like maybe 70, 80,000 tons being monetary gold. I'm talking about the gold that actually backs the paper currencies, the paper monies. And what that means is there's still about another 120,000 tons, if the market demands it, that can be moved from other uses into monetary gold. So it is very flexible. The point about it is that being flexible, it means that automatically the economic demands of the private sector, I keep government out of it, the economic demands of everybody transacting with each other can be met with that flexible money. Now, over the long term, while from the money side, the purchasing power is stable, but over the long term, because we always improve on productivity, we apply science, we apply progress, however you like to define it, we apply that to production methods, and that allows us to produce the goods which we sold yesterday at a more cost-effective price to the consumer tomorrow, and we amend it for the consumer. I mean, think what's happened with electronics goods, for example, how they've just improved and improved and improved. Now, if you had gold as the money, then you would see the prices fall even more quickly in that particular business. So what I'm saying is you need to look at the purchasing power of gold as stable, but the tendency for prices to fall in the long term is the result of technology and economic progress being applied to manufacturing processes. So it's very, very different from the Bitcoin situation.
The other follow-on question I'd asked in the same breath originally, which was a long breath, it was, what about silver? Why are we not seeing the same signal from silver that we're seeing from Bitcoin, indicating the collapse of the fiat currency?
I think the answer to that is that the authorities, if I can call them that, but principally your government, doesn't like to see metallic money at all. So they've sat on gold. And what this has meant is that if they sit on gold, then the attraction of silver as a monetary metal is even one further removed, if you like, from the reality of the moment. And indeed, I would say that the way silver has been trading has been more like a base metal. Because base metals have jumped in price a lot more than gold since last March, which is when this inflationary story really started, really kicked off. So silver, I think, has to become almost like trading like money, and it'll do that as the price of gold and the price of silver rises, because particularly as the price of gold rises, people will start thinking more in terms of the monetary elements of gold. And what they will then do, I think, is then begin to see that silver, if we're talking about metallic money, then we've got to move towards Sir Isaac Newton's relationship between gold and silver, which is 15.5 ounces to 1. Now, at the moment, we've got 60, the gold-silver ratio is 64.7. So you can see that the rising gold price means that silver could, rise at twice the rate for some considerable time yet. I mean, certainly until we get to sort of somewhere over $5,000 for gold, silver, could easily get up to $100 on that sort of move. And as we're talking, I mean, it looks like the suppression story is getting more and more difficult for the authorities to continue with gold, because the bullion banks are horribly short of gold contracts on COMEX, and there's no liquidity in London. They may get a little bit of temporary liquidity in London through central bank leasing, and I suspect that's been going on. In fact, we did see that when gold peaked up at over 2,000 in August last year, when GLD announced that some of its gold was being stored in the Bank of England. Now, that can only be because that is leased gold. In other words, the gold in the Bank of England has got two owners. One was GLD and the other was a central bank unnamed. And guess which one is more important? Under a lease arrangement, it remains the property of the central bank. So, go figure, as they say. They have got problems, I think, continuing to maintain this fiction that gold is not money. The whole of the Keynesian paradigm is actually under enormous attack now. I mean, we see every attempt to try and keep the economy going, rescue the economy. I mean, we know it's all failing. And we know it's failing because they're chucking more and more money at the problem, And what are they doing in the process? What they're doing is they are actually transferring wealth from ordinary people like you and me to the governments and to the banks when they issue bank credit. But in this case, it's particularly to the government, because the government are funding their deficit. How are they funding it? Minority now in America is through direct taxation. The majority of it is now through printing money and taxing us that way. So these are, we're on the cusp of big changes. And I think you were referring to that a little bit earlier. And I see also that, apart from the newbies who are getting involved with Bitcoin and sort of understanding the relative supply story, we're also seeing more and more serious commentators beginning to fret, I think, about the what they call the inflationary consequences of monetary policy. Inflation actually is of the money. Prices is what we see. But they're beginning to understand that this is something that could get out of control.
In counterpoint to some of the things you've just covered, we have a question from Scott Wilson, who says, regarding the possible gold and silver related currency standard, Martin Armstrong mentioned recently that gold can never be pegged to anything because of inflation, that it has never worked in history, that governments can't hold it. What do you say, Alasdair? I
say he's wrong. And in proof of this, I mean, look, it doesn't happen forever. I will accept that. But in this country, in Britain, we had a gold standard which sort of started in about 1820, where the first sovereigns were produced. I think 1817, the first sovereigns were produced. And we then had the Bank Charter Act of 1844, which formalized the arrangements whereby the issue of currency would have to be backed by gold. In other words, for every pound issued by the Bank of England, because the Bank of England then took on the note issuing responsibility, as it were, for every pound that the bank issued, it then had to find another 0.235, I think is the figure, 2435 ounces of gold to back it. In other words, it had to be backed by a sovereign. And you could exchange your Bank of England notes for sovereigns freely. And that stuck until the First World War. It was the First World War that changed all that. And of course, countries from that point went off the gold standard, particularly in Europe. And you could see the result in, Germany, Austria, Poland, and Hungary all went into hyperinflation. Britain couldn't, it went back on the gold standard, I think, at 24 or 25, and then it had to come off in 32 when the financial crisis really started to hit Europe again with the failure of Credit Anstalt, the Austrian mortgage bank, which was originally a branch of Rothschilds. When that failed, that was European banking system just sort of fell over at that stage. So Martin Armstrong, I don't agree with at all. It is perfectly possible to operate a gold standard. What we have to do, I'm afraid, is to have a massive fiat currency failure first, everywhere, to make all politicians realize that the one thing they must not do, for fear of their own assassination, is go back to unsound money. And I think that's what we're going to get. I'm positive in that sense. I think it's out of this chaos will come some sort of sweetness, and I think sound money will come out of it because there is no other alternative.
We have a question about signs you're seeing along the way, because you've been writing about those, tweeting about them, and little breadcrumbs of evidence that things are lining up in that direction. Mark Davies asks, the 10-year treasury this morning is at 1.38%. I believe Alasdair mentioned 1.26% and up would start the dollar to tank. What's his take on an accelerating percent increase?
Well, it's an interesting one because at the root of the question, I think, is an understanding of the different time preference between gold and paper currencies. Time preference is what should give you the rate of interest. What time preference is saying that the possession of this money in my hand is worth X. Me not possessing it, but looking perhaps to getting it back at some stage in the future, means that value, that future value, is discounted. And if you work the difference between the two, you can present it as an interest rate on the money. Mm-hmm. In the case of gold, you're looking at a rate of probably less than 1%. I mean, what I'm taking out of this is the risk of it not coming back. Mm-hmm. It's just literally the fact that I possess it as opposed to I don't possess it. Okay. Now, if, let us say, there is a wider recognition that the rate of price inflation in America is not 1% or 1.4%, whatever the most recent figure was, but it is closer to something like 10%, then the question is, what should the time preference value on the dollar be? And the answer basically is its future value compared with now is like 90 cents on the dollar. So, you're going to require an interest rate of roughly 10% to compensate you for that. Mm-hmm. Now, the reason we don't have this is because the market is rigged by the central banks, in this case, the dollar, particularly the Fed. And they rig it for the very simple reason that the government wants to print money. It wants to finance its budget deficit out of thin air from us without us realizing it, out of our wealth, out of our income, out of our pensions, whatever. The other side of the story, as far as the Fed is concerned, is, well, we will compensate you. We will drive up the price of financial assets. And that's what QE does. Because under QE, what you do is you buy government bonds and agency bonds off the pension funds and off the insurance companies through their banks, because they don't have accounts with you, and you give them cash. And they then reinvest that cash because they can't just sit on cash. And that is what's been driving the stock market up. That's what's been driving the spreads between, let's say, government bonds and corporate bonds down, or at least containing them, is all this extra money which the Fed has printed for the investing institutions. So we have a financial bubble. So that is the other side of the deal. Okay, we may be ruining your life by reducing the purchasing power of your currency, but as long as you stay invested in the S&P 500 constituents or whatever, you will get compensated for it, and you get compensated royally. And I wonder to what extent they are colluding in allowing the bitcoins of this world to rise, to increase that portfolio effect, that wealth creation effect, which actually conceals what they're doing by debasing the currency. It's a very, very dishonest situation, and it's very difficult for the ordinary person to see their way through it. I mean, isn't it wonderful? My Bitcoin are going up. Oh, really? Look at the other side of it. It's the other side that you should be looking at, and it's this money printing. And that's what's going on.
You mentioned a few minutes ago you're anticipating that in order for us to get off of this toxic spiral that we're in, that we need to have a massive fiat failure so that all the politicians have to wake up and realize that this is we all see, and the people would need to see that this is not sustainable. We've heard stories that Russia, for one, is trying to get off the U.S. dollar dependency and stabilize their situation more strategically. Do you have specific information around that to help us understand whether, in fact, they're trying to get a solid footing on gold reserves or make the ruble or their currency independent of the dollar, et cetera?
It's no secret. They've been dumping dollars for gold for some considerable time now, I think for the last 6-7 years. And they continue to have dollar income because they are the largest exporters of energy in the world. They are larger than Saudi Arabia, and they're larger than Saudi Arabia because they also have natural gas, which the Saudis don't. So, they've always got these dollars coming in, and as far as their reserves are concerned, they want to hold gold rather than dollars. And the reason for this is partly because I think there is an understanding of sound money at the highest levels in the Russian central bank. But also, the problem with the dollar is it's a weaponized currency. So the Russians know that if they are dependent on the dollar in any way, then they are in a weak position in the current fiat world. So, I mean, the situation is this has been going on for some time. China, I think, is slightly different in that China has cornered the physical gold market. That allows her to effectively control the future of the world money. That's why she's done it. From 2 points of view. First of all, if fiat currencies collapse, she's in a position where she can continue by turning her currency, the yuan, into gold substitutes. Of that, there is no doubt. It's my belief that she's got at least 20,000 tons of gold, of which she's only declared, I think, about 1,700 and something as monetary gold. The rest of it is all sitting there in various accounts, if you like, but not in the central bank's account. So, having cornered the market, she's also got, I mean, her citizens, in the form of jewelry mainly, have accumulated over 17,000 tons since 2002, when it first became legal to actually own gold in China. And with the opening of the Shanghai Gold Exchange, which is mainly a physical exchange. So they have effectively cornered that market. Now, this gives America a huge problem because when the dollar fails, and I'm saying when, not if, when the dollar fails, you're going to have the strategic issues of handing enormous power to China and Russia merely by allowing gold to be adopted, if you like, as the sheet anchor behind the new currency arrangements. And that is going to be very difficult, I think, for America, but she's going to have to bite the bullet on it. I'm afraid she's got no alternative.
This is a related question from Psycho Stacker saying, what central banks are buying gold right now?
Well, we never know until after the event, is the short answer. Basically, I think what we've been seeing in the last year or two is that a number of the Eastern European countries, like the Czech Republic, Poland, Slovakia, Hungary, and so on, they have been adding to their gold reserves. I think their gold reserves are probably still too low for what they want. The European situation is confused because of the euro, and that effectively takes the monetary situation away from the national central banks, and it's all sort of shoved into the ECB. But having said that, the German central bank, or is it the treasury, the French and the Italians have got very large gold reserves. So on a collapse of the euro, they can go back to a form of gold-backed money. But the other side of that deal is they're going to have to ensure that their government spending is always contained. And this is very important to both the French and the Italians, so that they don't run deficits. And if they're going to have successful economies, then they have got to withdraw as governments from interfering with the economies. They've got to reduce their levels of taxation and all the rest of it. Now, I know we can't see this at the moment because we're living in a world of Keynesianism and macroeconomics, which was invented by Keynes. But that has got to get destroyed along with the fiat currency, because all the preconceptions about fiat currencies are Keynesian. When the fiat goes, Keynes goes. That we're talking about a completely new paradigm. It takes a little while to get your head around it because we just can't imagine it. We've only lived with what we've got, as it were.
Well, I don't even know if it's a new paradigm. It's actually the original age-old paradigm. It's just that we've got to unlearn this I guess a jaded experience that we've got, that governments are always going to overspend, and that what will make them stop? Yeah.
Well, they don't always overspend, but I mean, if we return to what we had in the second half of the 19th century, but with an addition. And that is that we stop banks being able to print unbacked bank credit, which was the mistake which was made actually in the Bank Charter Act. That was a big, big mistake, and has given this what they call the business cycle, the boom and bust business cycle. I mean, that basically is a credit cycle, and it's a credit cycle created by the banks, and that has to stop. So let us go back to where we were in the late 19th century and change the banking system so you don't get that boom and bust on top of it. Then we will have a system that can work forever.
As we're waiting for the changes that will come that might issue into that future system, people are keenly watching, as you are, for signs of something big about to happen. Steve W. says, what are some of the signs we should be looking out for as a precursor to a financial event of significant magnitude? You've written about this all the time, but can you give us kind of like Alasdair's top 5 or top 10 things that to be wary of if you see them happening?
Basically, it's rising interest rates for fiat currencies. That has got to be the thing that undermines the whole situation, because if you get interest rates rising, then one thing that happens, I mean, and this is something that goes beyond the control of the Fed. The first thing we will see is the Fed continues to sit on interest rates at the zero bound. What happens to the dollar? The dollar starts going down. The Fed gets to the point where it's got to stop the dollar going down, because we've already seen that commodity prices are going through the roof. That then gets translated into not just a little blip at the retail level, but actually a major problem at the retail level. And there are various other elements of that I could go into if we had time. But you can see that a falling dollar is something that at some stage the Fed is going to have to say, we can't afford to do this anymore. And they will lose control of interest rates. And then you will see interest rates rise. And when interest rate rises, you look at government finances. What's happening to government finances? And then you look at the stock market. What happens to the stock market? You get a crash in the stock market, and suddenly the government looks completely insolvent, because its ability to just print its way out of debt has already been spent. That's gone. So to my mind, interest rates is the big thing. And the point about interest rates is that that will kill the financial asset bubble. And then there is a second stage, because as that goes, the dollar gets killed as well. Why? Because the future of financial assets has been tied very, very closely to the future of the currency. One goes, they both go. So interest rates are the obvious situation. But at the moment I'm looking at, and I'm drafting an article at the moment on a sort of, if you like, a slightly more subtle indication. I don't know how many of your listeners, viewers are aware of it, but the US Treasury has decided that it wants to reduce its bank account at the Fed, which is the general account, the government general account, from, I think currently it's around about $1.7 trillion, down, or 1.6 trillion, something like that, down to 800 million. by the end of March. Now, what this means is that and the way they'll do it is they will basically not renew. Well, this is the way most of it's done. They will not renew T-bills. So T-bill matures, you get paid out. You don't get the option to reinvest it in the next T-bill. So what that does is it unleashes nearly $1 trillion into the financial system, which basically is not offset by anything. Now, banks, they can, if you like, increase their balances at the Fed, the bank reserves. That's one way in which they could deal with it. If you look at foreign central banks, they can do repos or put it on deposit with the New York Fed, which handles all the foreign stuff, as it were. We're talking sovereigns here. But I was looking at the figures for private sector foreigners who basically have their deposits and their T-bills held within the banking system. Now, there's no way they can go with this other than just say bank deposits. You're then looking at pension funds and insurance companies where they've got their liquidity, or some of their liquidity, tied up in T-bills. They've got no other route. And importantly, the money market funds are limited to doing reverse repos, which is one way in which you can get rid of this cash, to only 30 billion. Now, that is not enough. The Fed is going to have to raise the ceiling if they're going to accommodate the money market funds. And not all money market funds, incidentally, do have a repo facility with the Fed. So what we're likely to see is very short-term money scrabbling for somewhere to go. Where does it go? It goes on the bank balance sheet. What's the condition of the bank balance sheets? The answer basically is we don't know for certain, but I think we can be pretty sure that there is very little room on the bank balance sheets to take in extra deposits because the gearing, if you like, is too much. They've just got no capacity. So the only thing that the banks can do is say, well, large deposits, we're only going to pay, or rather, we will tax it. We will take a negative interest rate. And that is the way you are likely to get negative interest rates very, very shortly. Meanwhile, the Fed continues 120 billion a month of QE, which becomes a separate issue. And that money goes into pension funds, into insurance companies, into the banks. And where does that go? Puffs up financial assets. So you can see that this situation is getting more unstable rather than coming under some sort of control. It's a worrying situation. I think it's this thing where it's an interesting article to draft, but watching these elements, sort of become apparent, I think is very interesting. And on top of that, you've got a bill going through the House. I think it's gone through the House, and presumably it's on Biden's desk for 1.9 trillion stimulus. Stimulus is actually another form of tax, but anyway, we'll pass on that.
Now, you've talked about a lot of different potential outcomes. With this one last question, I wanted to see if this one is one we haven't talked about. Edward Allen says he's been listening to people like Bill Holter, Jim Sinclair, Jim Rickards, Peter Schiff talking about future gold price 10,000, 50,000, 100,000, always as a calculation of dividing the world debt by the number of ounces in gold reserves, but they seem to ignore the one option the governments have to default on the debt. If a default were to be chosen, would this negatively impact the price on gold? And is a total or partial default on sovereign debt an option? If not, why not?
Okay, well, let's start with the forecast that gold is going to go to 5,000, 10,000, whatever. That is actually not the best way to look at it. The best way to look at it is dollar, sterling, euro, yen, whatever is going down. It's not gold going up. Undoubtedly, as the purchasing power of paper currencies falls, the purchasing power of gold will tend to rise a little bit. I mean, when you get a currency being destroyed and everything is having to go into another form of money, the original form of money, the secure form of money, then that becomes more desirable than it would be in more normal times.
But and when you say go up a little bit, you're talking about in terms of what it can purchase, like land or food or other real things.
Yeah,
okay.
Exactly. I mean, to give you an example, one of my favorite examples, I may have used it on your show in the past. In 1923, you could have bought a house in Berlin in a posh suburb, 6 bedrooms, all the rest of it, $100. $100 at that time is just short of 5 ounces.
5 ounces of gold.
So you can see that in the collapse of a fiat currency, the purchasing power of gold goes up. But most of it is the purchasing power of the fiat currency going down and impoverishing everyone in the process, everyone who does not have access to sound money.
So how does a default play out in a scenario like that?
Okay, debt default. Well, the answer is they just destroy the currency. If the government is no longer prepared to pay its debts in its own currency, then currency goes. It's actually as simple as that. The sort of MMTers have this sort of ridiculous idea that America dollars, it owes its debt to itself, and somehow you can sort of say that therefore it doesn't matter. Mm-hmm. It does bloody matter, because it's not a nation owing money to itself. It is people in a nation owing money to the government. And furthermore, it is foreigners being owed money by the government. So you can see that a government default basically just completely screws the currency. I mean, I can't think of a quicker way to wipe out a currency.
For people who want to follow up more on your current research articles, which you publish at least weekly, and your tweets that you publish frequently, where should they get plugged in?
Okay, well, goldmoney.com. I write an insight article every Thursday. It's published in sort of midday to early afternoon, I guess, EST. I also do a market report on Friday, same source. Go into market. I don't think it's called market reports, but it's the equivalent of that. So you'll see that on Friday, and so that's really maybe just a little bit of weekend reading. I write that in the morning European time, so very often the market's slightly different at the end. On Twitter, I'm at Macleod Finance. That's quite simple.
And folks, if you want to stay plugged in with not only all of our interviews with Alasdair and any links that he provides to his articles, but all of our guests and our platform, make sure that you don't miss out on anything by going to libertyandfinance.com. In the left-hand margin, put your name and email address. We'll get you on our mailing list 3 times a week. We'll send out an email with all of our guests and all of our recent interviews. And you'll also find us on Brighteon and on Rumble. We've been speaking with Alasdair Macleod, the head of research at goldmoney.com, this Monday, February 22nd, 2021. Alasdair, thanks for coming on.
That's my pleasure.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.